Let me describe something genuinely consequential that is unfolding across Africa and receiving remarkably little sustained attention in Western media. Between roughly 2000 and 2025, China has extended an estimated 170-180 billion in official bilateral loans to African governments, largely under programs associated with the Belt and Road Initiative. When commercial lending by Chinese state banks, trade credits, and project specific financing are included, total Chinese financial exposure to Africa over this period rises to approximately 280 billion, close to $250 billion invested across infrastructure, mining, energy, telecommunications, and transport. What few analysts anticipated is what followed once repayment pressures intensified. From 2023 through 2025, dozens of African countries faced mounting difficulties servicing these debts due to currency depreciation, slowing growth, pandemic aftershocks, and rising global interest rates. Yet, unlike traditional Western creditors, China has not generally responded by demanding austerity programs, privatization mandates, or political conditionality of the sort imposed by the International Monetary Fund or the World Bank. Instead, China has pursued a different form of repayment. Across multiple restructurings during 2023-2025, Chinese lenders have increasingly accepted equity swaps, asset-backed arrangements, long-term resource supply contracts, port access agreements, and operational control of strategic infrastructure in lieu of immediate cash repayment. The result is that countries unable to repay financially are repaying through strategic assets, often under contracts extending decades into the future. By late 2025, an estimated $30-40 billion of Chinese lending to Africa was either in default, under distress, or actively being renegotiated. Countries including Zambia, Ethiopia, Kenya, Angola, and the Republic of Congo, among more than a dozen others, have been engaged in restructuring talks with Beijing. Zambia provides a clear illustration. Carrying Chinese debt estimated at $6.7 billion against a GDP of roughly $30 billion, Zambia defaulted in 2020 and spent years renegotiating terms. During this process, Chinese entities reportedly sought long-term copper supply contracts at preferential prices, expanded ownership stakes in copper mines, enhanced control over transport corridors, linking mines to export ports, and access to power generation capacity serving industrial operations. Zambia's copper output, over 800,000 tons annually, is critical to Chinese manufacturing, construction, and energy transition goals. Ethiopia, owing approximately $14 billion, entered restructuring talks amid economic crisis and post-conflict recovery. Reported Chinese demands included extended access to Djibouti port facilities, already central to China's naval and commercial presence, long-term agricultural supply arrangements, operational influence over telecommunications infrastructure built by Chinese firms, and preferential access to emerging lithium and rare earth deposits. Kenya, with roughly $8 to $9 billion in Chinese debt largely tied to the Mombasa-Nairobi standard gauge railway, has struggled to generate sufficient revenue to meet repayment schedules. Restructuring discussions have reportedly involved port revenue sharing at Mombasa, long-term agricultural export agreements oriented toward Chinese markets, telecommunications control, and potential equity participation in rail and port operations should repayment challenges persist. Angola, China's largest African debtor at $20.25 billion, initially secured its loans through oil-backed repayment arrangements. As production declined and price volatility increased, servicing these obligations became harder. Subsequent restructurings reportedly extended oil supply commitments decades into the future, expanded Chinese stakes in oil infrastructure, granted port access at Lobito, and transferred operational control of major infrastructure assets built by Chinese firms. Similar dynamics are visible across the Democratic Republic of Congo, Nigeria, Ghana, Tanzania, and Uganda. In each case, China has shown a preference for long-term strategic positioning over short-term cash recovery. The assets involved are not marginal. Copper from Zambia and the DRC underpins global electrification and renewable energy expansion. The DRC produces roughly 70% of global cobalt supply, and by 2024-2025, Chinese firms controlled close to 80% of cobalt processing capacity, much of it acquired through debt-linked arrangements. Lithium projects in Zimbabwe, the DRC, Ghana, and Nigeria increasingly involve Chinese financing paired with guaranteed long-term supply access. African oil exports, particularly from Angola and Congo, flow to China under extended contracts tied to prior lending. Ports form a second critical pillar. China has secured operational control or preferential access to key maritime hubs, including Djibouti, Mombasa, Dar es Salaam, and Lobito. While outside Africa, the pattern mirrors cases such as Gwadar in Pakistan and Hambantota in Sri Lanka, reinforcing a global network that supports both commercial shipping and potential naval projection. Telecommunications represent the third pillar. Chinese firms built core network infrastructure across more than 40 African countries between 2000 and 2024. Where repayment has faltered, long-term operational control has increasingly shifted to Chinese entities, raising concerns among Western security officials about surveillance, data access, and strategic leverage, concerns African governments have limited ability to counter given the absence of comparable financing alternatives. This approach contrasts sharply with traditional Western lending. IMF and World Bank programs historically imposed fiscal contraction, subsidy cuts, privatization, and market liberalization, often triggering social unrest but theoretically restoring sovereignty once debts were repaid. China's model avoids immediate austerity and political interference, making it attractive to African leaders. But when repayment fails, sovereignty is exchanged not temporarily but structurally. Over the next 20 to 30 years, the implications are profound. Control over cobalt, copper, lithium, rare earths, oil, ports, and digital infrastructure gives China leverage over global manufacturing, electric vehicles, renewable energy systems, and maritime trade routes. African economies become increasingly oriented toward Chinese markets, Chinese logistics, and Chinese technology platforms. Political alignment often follows economic dependence, influencing voting behavior, trade positions, and diplomatic stances across more than 50 countries. Africa gains infrastructure, jobs, and access to Chinese markets while avoiding IMF austerity in the short term. But it pays through reduced control over resources, constrained economic diversification, environmental and labor trade-offs, and long-term exposure to Chinese political and economic pressure. What is unfolding is not a financial failure for China, but a form of strategic financial statecraft. Loans totaling roughly 280 billion are not being repaid in cash, but converted into decades-long control over assets and supply chains, potentially worth trillions. Infrastructure was the entry point. Debt distress is the conversion mechanism. As of 2025, China is not retreating from Africa, it is consolidating. And the consequences of that consolidation will shape global power dynamics for a generation, whether or not Western governments choose to acknowledge it.